Hedge funds have become synonymous with high-stakes, sophisticated trading, and their secret sauce often lies in the algorithms they use. Imagine a bustling trading floor where split-second decisions can mean the difference between a big win or a major loss. This is where algorithmic trading steps in. Hedge funds deploy a variety of algorithms and quantitative models, each tailored to exploit different aspects of market behavior. By the way, if you're looking for a reliable broker with very low deposit requirements and quick withdrawals, see the links in the description box below. One of the most intriguing approaches is statistical arbitrage. Picture this: algorithms that scan the markets for price discrepancies between related securities, jumping on opportunities where prices deviate from their historical norms. It's like finding hidden treasures where the market has temporarily mispriced assets. Then there's high-frequency trading, HFT, which operates at lightning speed. These algorithms are designed to capitalize on minute price movements by executing thousands of trades in the blink of an eye. It's the epitome of rapid-fire trading, where every millisecond counts. As technology advances, so do the methods. Enter machine learning models, which are reshaping trading strategies. These models analyze vast amounts of historical data to predict future market movements. Think of them as sophisticated predictors that learn from past patterns to forecast trends, using everything from neural networks to decision trees. In a world where news travels fast, sentiment analysis algorithms have become crucial. They sift through news articles, social media, and other sources to gauge the market's mood. This analysis helps hedge funds anticipate market reactions before the broader public catches on. Risk management algorithms are another critical piece of the puzzle. They're designed to assess and mitigate risk, employing strategies like diversification and dynamic asset allocation to protect against potential losses. It's like having a safety net that adjusts based on the market's twists and turns. Finally, let's not forget factor models. These algorithms use various factors such as value, momentum, and volatility to guide investment decisions. They're akin to using a detailed map to navigate through different asset classes, ensuring that investment choices are well-informed and strategic. Each hedge fund might blend these techniques differently, creating a unique mix that aligns with their specific strategies and goals. It's a complex dance of algorithms and data, all aimed at staying ahead in the ever-evolving financial landscape. If you're looking for a reliable broker with very low deposit requirements and quick withdrawals, see the links in the description box below.